I'm Greg Hunter. Welcome to USAWatchdog.com. With us once again, best-selling author of this book and other books. This is All the President's Banker. This is the paperback, which has been out just for a few months. Here's the original hard copy book, All the President's Bankers. Very interesting book. A lot of notation, a lot of interesting stories about, present-day bankers all the way back to Kennedy and Teddy Roosevelt and all that. Great book. I have, if you've guessed already, Nomi Prins. You guessed correctly. Nomi Prins, thank you for joining us from the West Coast.
Thank you very much again, Greg.
Well, I want to start with your meeting with the IMF, the Fed, and the World Bank. They called you in, which I thought, wow, they called her in? I can't believe they called her in. She's going to drop a bomb on their head. And, of course, you did. Tell me about your meeting and the uptake of what you told the central bankers, which I hear you were very well received.
There was a 15th annual conference that the Fed, the IMF, and the World Bank have been putting on for 15 years, and they do it each day at a different location. So it's a 3-day conference. I was speaking on the first day at the Fed, which was the opening day of the conference. It was interesting. They invited me, and I was honored on one hand, and I was also surprised on the other because, as I said to them before the conference days, I don't really agree with anything you've been doing, so I'm not going to hold that back. I'm going to be honest with my opinions. They're on record. They're all public. I've been talking about this stuff for years, and they're like, no, that's totally fine. That's what we expect. And I even sent them my slides, which are on my website now. Everybody can see them in advance of the conference to make sure that they knew what I was going to be talking about. So that was very interesting. And one thing that was cool actually before I spoke, so in the morning, I spoke the first morning, but just, in the sort of coffee bit before that, that a number of people who've been at the Fed for, one of them 30 years, were talking with me and saying, look, we're at a point where we're just really scared, and there's a lot of internal debate and confusion as to what the direction should be. So it isn't like everyone inside's on the same page. There's a lot of concern inside.
The Fed actually said, the inference or the words were really scared about what's going on. They actually said they were scared?
One of the members who's been there a long time. Not the spokesperson for the Fed, but certainly one of the internal worker bees.
One of the insiders.
Who's been there a long time and seen a lot of changes, a lot of policy shifts, and I think that was not just the inference. That was what we were discussing before the talk, and that's what I discussed when I spoke in front of the attendees, which were central bankers from around the world. From Thailand, from Lebanon, from Brussels, from all sorts of places.
Why was this insider scared?
Because of the difference, I think, between what's said on the outside, and this is my perception, what's said on the outside to the public, and what gets debated on the inside. And it seems like on the inside, there's actually more concern at sort of lower levels. And when I say lower, I don't necessarily mean in terms of years at the Fed, but just in terms of, being the senior sort of power broker elements of the Fed, that they understand that there's a mess that's been created. They know, or I'm not saying all of them, but a number of them understand that they are backed into a corner, and it wouldn't have necessarily been everyone's decision to do what has been done for the last 7 years in terms of zero interest rates, in terms of quantitative easing, and so forth. They understand, and this was the tone of the conference, they understand there's an inherent instability going on. Now, not everyone admits that, and not everyone may understand that, but there's certainly a group of people inside that do, and that's where the internal concerns seem to be, that they understand there's definite instability, that these policies have not actually created a better system, despite the fact that some people at the Fed, at the Treasury Department as well, who spoke there, believe that there has been more financial stability because of the actions that were taken, and then there's a group of people that just believes it's kind of kicked the can down the road, and it hasn't, which I believe as well created financial stability throughout the world. And it certainly hasn't trickled down to the main economy. There was one fellow who spoke very interesting, a cardinal actually, a senior cardinal who had just been, talking to the Pope earlier in the week. His name escapes me. He's on the record, but old guy, in his 80s, and he came and he said, you guys here, he spoke to the room just before I did. You have to understand that at the end of the day, what you do here You powerful people who set policy, who control money, all that. What you do here really is supposed to help the poor people of the world. And like, this is what he said to them, like his words, and he quoted some stuff from the Bible and everything else. But the point was, you have the capacity to do better than you're doing, and to do better for more people than you're doing. And that's not happening. So
Elizabeth Warren, she got it right. Before she was senator, she said we bailed at the top and we told the bottom to bug off. And nothing is more apparent than the recent news that Lloyd Blankfein at Goldman Sachs, your former company, we were a managing director, I believe, pretty high-ranking banker. Lloyd Blankfein is now a billionaire, and that company should have been taken to receivership along with AIG.
Yeah, let's go back to the fact that that Lloyd Blankfein is a billionaire is the example of what's wrong with everything in the world of finance, economics, and politics. Number one. But number two, go back, as you mentioned, AIG, Goldman, and so forth. That fall of 2008, and it's been talked about to death. There've been tons of books. I wrote It Takes a Pillage on it, and so forth. It wasn't just that Goldman received $12 billion from the government through AIG to fix the money that AIG owed to Goldman because of the deals that Goldman decided to do with AIG. All free will, all free market, all private institution relationships, right? That the government came in and officially gave money to AIG to give money to Goldman. Who did that? Hank Paulson, who was the Treasury Secretary at the time, who had been Lloyd Blankfein's boss at Goldman right before he became the Treasury Secretary, and who was the reason that Lloyd Blankfein became the CEO and chairman of Goldman after he left, because Lloyd just went up and took his spot. So all of that's happening in the politics of Wall Street, the politics of finance. Then you get this money, and not only that, you also get the Federal Reserve at the time under Ben Bernanke at the request of Hank Paulson and also Tim Geithner, who was the New York Fed president at the time and then became, of course, the Treasury Secretary for Obama, the next year, who said that Goldman Sachs also needs to become a bank. So in addition to getting money from the government for specific private derivatives trades they engaged with on their own free will with AIG, they also got to become a bank. In the vein of banks that take little people's deposits, in the vein of a bank that has FDIC insurance for people's deposits, in the vein of a bank that, for better or for worse, gets Federal Reserve support and cheaper money from the Federal Reserve window when it needs to, and government support and so forth, because it has deposits. But it didn't have any deposits. It had a little tiny little Goldman Sachs bank somewhere, but for the most part it still doesn't deal, nor should it, but it doesn't deal with the individual at a regular, normal financial capacity basis, the regular population. It deals with big countries, big deals, big corporations, big leverage, big trading. And that's what it did at the time. And so in addition to the money it got from the government for the AIG trades, it got to become a bank and get all the extra protections it never should have gotten in order to stay solvent, in order to continue to perform. And now the stock is up, 400% since those times between late 2008, early 2009, and Lloyd Blankfein's a billionaire. It's everything that's wrong with policy.
Well, let's just fast forward to today. So we know what got us here, all this money printing, and they couldn't let anybody take a hit. I mean, that's the problem. Isn't that what you told them? Is that basically, if you boil it down to somebody with my IQ, which is pretty low, that'd be like, hey, the banks, the rich people, you all need to take a hit, and they didn't want to. Isn't that the problem?
They didn't want to. They perpetuated the myth that by not taking a hit, by the big private banks not taking a hit, it would somehow filter down into the general economy and everything would be fine. Now, one of the things that was discussed throughout those 3 days, not just by me but other people, was that this hadn't happened. This idea of on-lending, of stabilizing the economy on an individual population basis, hasn't been happening. And what I said was, well, of course it's not happening. You give the banks a whole pile of money. You give them a whole pile of help, a whole pile of aid, ongoing for 7 years. Now, this was supposed to be an emergency, temporary kind of stopgap for a crisis situation. We're going on now 7 years of zero to low interest rates. It's become a global process. You have a $4.5 trillion book of debt on the Fed's books that effectively is elevating the price of bonds and debt securities, which keeps the rates down as well, which is quantitative easing. You're buying $1.7 billion of that mortgage-related product from the same banks that tanked the system, and you're allowing banks like J.P. Morgan Chase to manage the mortgages you bought and given them cash to do. So everybody on the banking sector is making a lot of money. And the slide I showed them, and again, it's on my slides on my website, people can see it. But I don't even think they knew this, which kind of surprises me. And maybe some did, some didn't, I can't say. But 43% more deposits are held now by the big 6 banks in the United States since before the crisis. 84% more assets by the big 6. 400% more cash. So we can talk about all these, regulations like Dodd-Frank, good or bad, Republican or Democrat, whatever. But the point is, the big 6 banks control more deposits, more assets, more trading, more cash than they did before. So it doesn't matter what you tinker around the edges. That's the fact.
So let's fast forward to right now, the fear. What are they afraid of happening to the economy? What is their big fear? What are they afraid of? What are they afraid of this blowing up? Everybody says this is unsustainable. Peter Schiff and other people say they made it worse. They made this far worse. And obviously your slides say they made more concentration of wealth. The banks are bigger. They're more leveraged. So what is the Fed? What do you think they're afraid of? What do you think could happen?
Their fear is that the liquidity that they've supposedly infused into the system through epic, unprecedented artificial methods, the ZIRP, the QE, all the initial loan facilities in the beginning, all the money they've basically, the money supply growth that they've dumped into the markets to make them appear healthy, and the banks effectively, who are in the crux of those markets, by controlling so much of them, the assets and the trading and everything else, keeping them afloat, that if they pull that plug, right, if that liquidity somehow falters, if the even fear that it falters starts to perpetuate, that things start to tank and implode very quickly, because the only thing that is keeping this market up, the only thing that's keeping these banks up, is either the artificial funding, that the purchasing of bonds, whether it is in the United States or in Europe or, China is intervening in their own markets, but basically the central bank intervention on behalf of the private, larger institutions and the markets in general is the only thing that's keeping it going. Now, the other body that interestingly became aware of this, well, two, the BIS, the Bank of International Settlements, which was started in the wake of the Great Crash in 1929. It was begun in 1931 to effectively help the central banks stay liquid so they could stay liquid for the private banks. They just issued their annual report a couple weeks ago, and they said that the global markets are dependent on the central banks. That's what they said. So when you get the central bank of the central bank saying this, that's not a warning sign. That's a big red flashing light. And that's what's going on. The IMF said that at the time. They've been saying that volatility is increasing. They've been suggesting more liquidity and more QE, whereas the Fed parts of them are talking about interest rate hikes, and the IMF is saying, you do that, you're going to create a bigger liquidity crunch. And so that's really the main fear, is what actually can be done to even go back on some of these policies. And the reality is they've created such a disaster environment, because it's so unsustainable and it's so artificial, that any type of backtracking will have major ramifications in the market. And that's beyond regular problems that can happen, whether they're geopolitical or credit defaults or anything else that happens in general in a major global financial system.
So if they pull it away immediately, it crashes immediately. If they keep doing what they're doing, doesn't it still crash, but a little later? I mean, we're headed for a crash, are we not?
Well, and that's what we've talked about, and that's what I've been saying. You can't sustain a policy that's so artificial forever. Now, it has been sustained for 7 years. That's a really long time. The ECB has already announced they're going to sustain their version of QE, which is just another leg of this entire process, until the middle of 2016. And that's just what they said earlier this year. Now, it can be renewed, it can whatever, but at the moment, that's kind of a major date, the middle of 2016, the summer of 2016, where supposedly they're going to stop supporting basically the larger European elite banks by buying their bonds. That's what they've said. So what they've done, yes, is they continue to push the can of actual stability on the ground level that's more sustainable by lavishing the markets with all this liquidity. And yes, if they were to take it away right away, there would be an implosion right away. But they're not doing that. They haven't done that. What they're doing is kind of testing. We'll give a little, we'll take a little. You know, the Fed's kind of backed off QE, but not really, because the big private banks in the United States have been stepping in to buy the bonds, the extra bonds that the Fed's not buying anymore. So there's still this codependent relationship and policy that's going on. It will implode. I've said this. It is a question of timing, because you can't sustain this. However, it has been sustained for a longer, more exaggerated, more unprecedented period than ever before, certainly than ever. The Fed was created in the last 100 and something years. Throughout the entire system of fixing private banks with central bank liquidity or policies, that's just gone on for a ridiculous amount of time. So it can continue, but it can't continue forever because it hasn't fixed anything.
What do you see could happen that Wall Street could front run this trade? I mean, they know it's ending. Wall Street knows this is ending. You know how Wall Street is. They love to get in front of a trade. So what do you suppose, is there anything that could short circuit this thing early? I mean, it sounds to me that you don't think anything will crash this year. It'll be later. What do you say about that?
First of all, in this year, there is still definitely heightened volatility. Just the stress of wondering, of having these more and more conversations. There has been a topping out of a lot of the markets in terms of this jagged up and down near the top, but not a real push going upward. So there is a lot more volatility and uncertainty about what will happen in the market today than there was a year ago. So I do see a lot of down moves and followed by smaller up moves, but yes, not a full-on drop until it's really retracted from the standpoint of central banks, the types of support they've provided the entire market, which again has a sell-by date. I believe 2016 mid, when the ECB is supposed to stop, starts to show us that date. And before that, there's a lot of volatility, a lot of scared people and scared investors. What the banks can do, to get back to your question, to front run it, what I've seen, and I mentioned this also to the Fed, is that the level of derivative trading in terms of the categories of derivatives that are traded globally has really increased in terms of interest rates and FX-related derivatives. Now, it used to be commodities, equity, different things have increased in different periods because banks like to take the trade that's most profitable to them at the time, that they can front run the most, that they can be involved in the most, that they can make the most money the quickest way, the most. But interest rates and FX have really increased relative to the other categories of derivatives. So I believe that's where there's going to be, and there is, a lot more manipulation and sort of moving back and forth to front run what could happen in ways that aren't necessarily transparent. Because not all of this stuff is all the swaps and everything are traded in a way that's transparent. There are a lot of side deals that go on that aren't over the counter, that aren't obvious to the market. And so I think that's what's happening, and that's what I said to them. The next place is also going to be fraud, is the place where there's more volume, and that's in interest rates, and that's in FX. That will be shown after the money has been made.
J.P. Morgan and some other banks just admitted criminal fraud. I mean, of course, they didn't. The bankers didn't. The buildings, the walls, the carpets, the desks, the phones. That's who did the fraud, not any of the people inside the bank, which I find bizarre. But John Williams says that the economy is declining, and that we could be in a full-on downward spiral, and if that's the case, they may start printing money like crazy, which incidentally, the BIS said that the next time there's a crash, the central banks are out of ammunition. I don't know if that's their exact words, but something pretty close to that. They said they won't be able to help next time. So if we get into a big downward spiral that they keep telling us that we have a recovery, and you know what's a recovery at the top and not at the bottom, and they keep telling us we have this big recovery going, but if the recovery, if the realization happens and the Fed goes, oh my gosh, we have to do something again, and it starts imploding, couldn't people just lose confidence? Boom, they would just say, wow, this is not ever going to end. Sell, sell, sell. Couldn't that happen?
Yeah, and I think that the days when there's the enhanced volatility in the market are signs that that's where it's going. And that could definitely happen when the rug is 100% or even a large percent pulled back in terms of liquidity central banks have provided the financial systems and the big banks. So yes, by them turning back, that could be a problem. Whether or not that,
but not hold on just a second. But not if they just wrap it up again and start saying, "Wow, we're going to start buying bonds again, and we're going to start doing QE4." So you think then everybody would go, "Oh, ooh, wow, the central bank's stepping up."
There would be a rally in those moments because I mean, look at what happened in China. The second they intervened in terms of the downward, 30% fall in a month of the stock market there, all of a sudden everybody breathed, things went up. That's an artificial intervention on a massive scale. It's not a small market. So if the Fed were to come up with a creative way, because they would probably want to save face, we said QE was over. We've been talking about hiking rates maybe for the last 2 years. It hasn't happened, but it could. What else do we need to do if there's a major fall to fix the banking system? They're going to have to come up with a QE4. That's one of the things that the IMF was talking about in response to the possibility of the Fed raising rates. That actually, the better thing to do, in the IMF's opinion, is to continue the quantitative easing policies. Now, the rates in Europe are negative. The Bundesbank call sheet on basic interest rates has them at minus 0.83%. I mean, where do you go? And they're buying 60 billion euros worth of bonds from the major banks every month. Compare that to the fact that Greece needed that stopgap to keep going and instead wound up with an extra infusion of austerity. But that's something the ECB does every month. Can it step that up? Yes.
When are they going to raise interest rates? I mean, they keep. How have we been hearing this? We're going to raise them. We're going to raise them, and then the economy, gets a little shaky, and something happens, and they don't do. It's been a year and a half, 2 years. I mean, they're talking about a September interest rate hike. Now, some people say they may be forced to raise rates to basically save their credibility. They may be forced to raise rates. They may have to do it, and I talked to Greg Manarino, who's a guest on the show, and I say, if they do that, I mean, aren't they going to intentionally crash the economy? And this idea that, we're going to start raising rates and the economy is going to be great. What do you say about that? Are they going to raise rates? When are they going to raise it? If they do, what happens?
They back themselves into a corner, right? So one of the things I even said when I was there is if you raise rates 50 basis points, the market drops immediately 500 points that day. That's what you're dealing with. That's just the reality of the situation that's been created. I mean, it's just a reality. Maybe the market would be like, oh, phew, it was only 50 basis points. We thought it was worse. Communication, media, chatter and stuff, and maybe it bounces back a little because the conversation then becomes, well, they're not going to do it again. They did it. They saved face. It's fine. That's one school of thought. I think that if they do raise rates, it would be by a very small amount to save face. The markets would tank, and then they would really quickly go back to, the economy's really, really bad, by the way. We didn't notice it before. Find some more stats to prove that, and then completely stop from raising rates going forward. Or they don't do it at all, which is kind of what's been happening, because they continue to, market goes up a little, economy goes up, and they're like, employment wasn't so good this month. Things didn't expand so good this month. Greece, Europe, China. And they don't. Because the reality is if the Fed starts to raise rates, given how bad this policy has artificially infused the market over the last 7 years, they do create a very big knock-on effect. Europe can't raise rates. I mean, everyone can raise rates, but they're not going to raise rates. And so then you have a situation where the dollar is even stronger. That hurts weaker economies throughout the world even more. And you're buying and creating and buying more debt, and you have to ultimately go into another quantitative easing phase anyway because of the damage that will be done by the rate hike. So it's a problem. I think either it's very small and they find better economic reasons the next day to never do it again or not do it for a really long time, or they simply, a bunch of bad economic data comes in and they say we're not really there yet, which is what they have been doing for the last year and a half.
By what you're describing, and I'm just going to boil it down to my, small intellect here, it sounds like to me they're trapped.
Yes.
They are. So you think the Fed? Explain what you mean by that. They are trapped.
Yeah, whether they really believe themselves or were hoping it would turn out differently. In the beginning of this, this emergency measure of what became a $4.5 billion quantitative easing program, zero interest rates for 7 years in the U.S., €2.5 billion in Europe, negative rates there, China going that way, Japan go, all of that. I think maybe in the beginning they believed that somehow the banks would turn around and offer all this extra liquidity to the real economy, real people, restructure their debt, and everything would be fine. I don't know why they would have thought that, because there's no indication that, a big bank that gets a lot of perks is going to share them. I mean, that's not their job, really. And there was no strings attached. That was one of the other things I said. You guys gave a pile of money and a pile of support with no strings attached. Now you're wondering why that wasn't on lent to the rest of the economy. You said it would be, fine, but you didn't actually provide any rules or regulations or anything to make that happen, and therefore it didn't. So yes, they're in this tough spot where they fed into this like Frankensteinian banking system, especially in the U.S. It should be noted that it is the U.S. banks in particular that are bigger and stronger and have been more helped by the Federal Reserve than some of the elite European banks, all of whom have actually swapped up their CEOs, gotten rid of people, had much more shifting in their structures. They're still very big, the big ones, but then the U.S. had. It's the U.S. banks that have taken the lion's share of the settlements, $130 billion globally for fraud and crime. So it is based on this, but the Fed, as the instrument of engaging this entire process, has not really been able to make the real economy benefit, regardless of what they say has happened.
But they are in a, is it safe to say, they are in a policy trap. They're damned if they do, and they are damned if they don't. Is that right? I mean, there's no way out, basically.
No, that's exactly right. If they raise rates meaningfully, it will cause a tremendous down crash in the markets, right? And also it will really hurt international markets and international economies as well, which are already and continue to be hurt to begin with. Just not on the up level, because, on the official basis, international markets are all high. They're all still near their records, right? But their economies, as we know, are suffering.
And if they continue this padding, this QE, this low interest rates, this whatever they're doing in the Forex markets, the fraud, they just invented that in the Forex. If they continue it, doesn't it blow up also?
Yes, because ultimately there's only so many things the central banks can do. The issue is, though, that they keep finding more to do, and every time they announce anything, it pops the markets up, because it's sort of like a Hail Mary of artificiality, and it does help because the power is so concentrated at the top of the private banking system, at the top of the most elite central banks, that they kind of are codependent on each other, and so those moments help. But because it's not real, because it ultimately hasn't translated into real growth, real economic stability, real profitability, real sustainability at the population level, it's all very tenuous. And again, that's the problem. We're trying to pinpoint when these central banks really start to change their policy, but at the same time, they have no backup plan. They have no plan B. They have no alternative policy. They have not imagined what else in their power they could do, and instead they've become a more powerful arm of this codependency as well relative to the private banks. So it started out they were helping the private banks. Now they're trying to help themselves. So the concentration has gone from simply being a private bank, Wall Street, international big bank concentration of power and capital and influence on the major markets, to, because of the epic help that the central banks have provided, those major central banks have also become major power players in sustaining this artificial system.
So if they continue this, aren't we going to get some huge inflation? I mean, if they continue, because it sounds to me they're going to continue it until it blows up. They're going to run it until it just the wheels go off in front of the train and they just go over the cliff. I mean, that's what it sounds like to me, that they're going to run it until it blows up. Don't we get big inflation?
Well, the markets are inflated. That's the whole thing. It depends where we're looking for inflation. There's absolute asset bubbles all over the place, particularly in the bond market and in the stock market, because this artificial infusion of money has gone through the banking system into places where they can find return, because there's no return anywhere else because rates are at zero. So you finish out the bonds, you go to the corporate bonds, then you go to the junk corporate bonds, because that's where you reach for yield, and so that's what has happened. But at some point when those corporations can't repay, like, for example, the oil and gas industry is back in the news again this week because oil prices are down again, and therefore what are these mid-sized companies that have had all these extra loans from banks going to do when they need to actually pay them back because they can't make enough money at those oil levels to pay them back? They start to default. So there are asset bubbles everywhere in these loans, in the bond market. The stock market is at ridiculous highs given the fact that even the participants are buying their own stock and continue to with the cheap money. It's all a series of inflation on the financial level, on the financial instrument and market level.
And do you think that's why they're attacking gold and silver? I mean, the Treasury stopped selling silver coins. They're selling so many, they just said, "Ooh, we're going to stop selling them." They had all these contracts dumped. I mean, billions of, the mining production for a year or something crazy like that on gold. Gold's been hammered. Do you think they're doing that to get people away from tangible assets and away from precious metals because they know this is going to continue and they want to make gold look and silver look as bad as they can?
Well,
it's manipulated. We know that.
Well, A, it's manipulated. B, in particular, the last couple weeks, there's been documented speculation, additional selling of gold and silver. So there's more and more of the sort of big speculators, not the regular people who are buying gold and then dumping it, but actual real speculation is going on an increased basis in the gold market in particular. So that's a way to manipulate the price down. It also tees off the fact that the gold price has been going down anyway. And part of that is because of the dollar. This policy that the Fed has gone on has had the effect, which it should not have had, of keeping the dollar up. In a normal functioning economic financial system, you inflate your economy with debt. The value of your currency is supposed to go down. I mean, that is what is supposed to happen. But we're in this weird world of central bank power infusing the entire system and sort of creating money out of nowhere to keep it going in this vein, that you have currencies that shouldn't be strong be strong. The rest of the economy in the world is so much worse than the United States that even if the United States is bad, it makes the United States look good. And so there's all this weird stuff going on. And gold is having sort of the back recipient effect of that. That's why another reason that gold has gone down, because these policies are continuing. Yes, they shouldn't. Yes, they're bad. Yes, they're artificial, but because central banks have nothing else to do, they will keep on doing them as long as they can. And that's also depreciating the value of gold. And the other thing is that gold's not being discussed in the media as a positive asset. There's a lot of wording. And that's why, you mentioned before about, gold manager. A lot of gold managers I've spoken to have seen that, individuals aren't coming in anymore. They're scared because they've seen a depreciation of their asset, and they're not inquiring to buy because the story throughout the mainstream press globally is that gold's depreciating. It's not a good asset. So not only do you have speculators against it using that story, you have central banks not wanting gold to be high because the dollar is staying up, which gives the U.S. power throughout the world, which it already had, but more so. And gold is not being promoted in a way. Gold is actually also not being promoted. And in this kind of an economy with so much fragility and stability, messaging, that also impacts the price.
Could they just lose control? Could this thing just pop? Could we just wake up, go home on a Friday and Sunday night the president come out and say, and I don't know if he's going to do this or not, but the president come out and say, the bank's not going to open tomorrow. We've been hacked, or we got war, or we have some kind of black swan, some kind of, I've even heard that Sweden wants to join NATO and Russia is threatening war. Couldn't there be some black swan that just knocks the central bankers right out of the saddle by surprise?
A war with Russia could definitely, or even a escalation of the neo-Cold War that the Obama administration has invoked against Russia could certainly have a knock-on effect. We've seen before the current crisis of Greece is supposedly contained, if you ask, Angela Merkel or the Bundesbank or the ECB, because they've agreed to this additional level of austerity and basically pillaging the country, which is obviously not going to sustain their economy. It's so obvious on so many levels, and yet it's happening. But before it happened, there was a lot of concern on the central bank level. That wasn't really discussed in the press. It was much more about the political union of the euro and how Greece needs to stay in. But I believe behind the scenes, there are probably a lot of fearful conversations about the financial system, not just the relationship of Greece and the and the euro idea politically, which was also a part of it, but also the fact that you don't want any chips to fall off your table. Anything could open the doors for a run on liquidity, which is also why I talk about individuals. What they should do more and more now is try to preserve their own liquidity and take more cash out of the markets or out of banks to just have on the side during the period of volatility before we have the actual crash. While it's still in a tenuous situation.
Well, I mean, for somebody like you to say, "Whew, go to your bank and buy and get cash." You wrote that this is money you can hold, or it's the difference between money you can hold and money the banks can take away. And you're saying take some cash out of the bank.
Right,
and you're afraid of a bail-in. Is that right?
There are discussions. I'm afraid of different things that look like a bail-in up to the level of a bail-in, right? Because anything from further reductions in the amount of ATM withdrawals, extra fees on managing savings accounts which don't provide any interest anyway, extra fees on checking accounts, on small business accounts, all of these things are actually ways for banks to keep your money and to take your money away. These are increasing on a kind of regular basis in the wake of having also zero interest rates that banks are allowed to not pay for your money. So this is happening. That's kind of a low-level bail-in, if you will. Now, there's also been, and you've talked about it, others have talked about it, a lot more documentation coming from the major banks saying it would be good not to have cash, effectively. It would be good for everything to be electronic because that would mean it's all controllable, it's all traceable, it's all stoppable if banks need it. That's the last bastion of liquidity to banks. If they fear that at some point the central banks won't be able to continue what they're doing or find new ways to do exactly what they're doing, and there is a liquidity crunch, then the sensible thing from their perspective to do is to be able to either take or stop the withdrawal of people's cash. And so that's where these papers are coming from. It's not an accident that they're happening now. It's banks saying, look, we've ridden this thing for 7 years. Maybe we ride it for another year. Maybe we ride it for another 2. But you know what? What's another thing that we can look to in terms of preserving ourselves? Oh, wait, cash, people's deposits. We have those. How can we keep them? How can we stop people withdrawing if we don't want them to? And that's their argument. And so you look at Greece, which closed its banks and then, obviously just opened its banks. That was not quite a bail-in, but it was definitely an obstruction of cash. There was a reason for it, right? It was, because of what was happening in Greece in particular. But big banks here can use that reason to continue to promote this idea that they should have more control over our cash. So I fear that. I see that. And that's why I think it's important for people to just front run that a bit for their own sake. It's a little bit safer now than gold is now.
Cash.
Yes.
And what about the stories I hear that this fall they're going to, China's going to come out and be put into the SDR, the special drawing rights currency, and that this could have the dollar could take a hit. It could really challenge its world reserve currency status. What do you think about those stories that's coming out this September, October, that kind of time frame?
I think those stories, the actualities of those stories, as well as the Asian development type infrastructures that are being created, those are all ways that countries outside of the dollar bloc or officially want to keep their own strength and grow their own strength and be independent from the dollar. But in a tenuous world where, again, the Chinese stock market can fall by 30% in a month, it's hard to imagine in that world, in the short term, they're going to chip away at the dollar. Over the long term, you have to plan that. And it can be and which is what they're doing, and it can be a longer drawn out thing. I actually spoke with one of the individuals at one of the larger banks in China recently. We were talking just about that idea, like how much is China kind of breaking away or leading the way, and what's the impetus for that? We talked about it, and it does go back to the financial crisis of 2008. China was outside of that crisis. Right? It didn't at the time have the same impact from what really the U.S. banks and a little bit of the European banks did to the world, right? U.S. had the impact, then Europe has the impact. China was a little bit left out because they weren't involved. They just were not involved in toxic assets and leverage and distribution. So they said, wait a minute, how do we actually preserve ourselves going forward? However, in the meantime, they've also let a lot of U.S. and other capital investors into their stock market. ETFs now are including more and more China mid-sized companies, which means there's more control. U.S. created ETFs. There's more control over what can happen in those markets now. So that's why it's harder to believe that an extra outside currency will skyrocket up relative to dollar right now. But going in that direction, yes, that it can definitely chip away in the future. But in this, again, artificial financial central bank controlled system that we have right now, it's going to it can't get that momentum right now. It can create the possibility of that momentum in the future. Now, this is not all what should happen. This is all just because of the very artificial land in which we live right now.
And final question, Rob Kirby said this, and it was just something because he buys and sells gold. He actually buys tons for people, tons of gold. And he says that even though the price is going down, the demand is super. But he said one thing he's heard, and I just want to get the one thing you've heard. One thing he's heard is people just, I hear this, that they're freaked out. That I've never heard them say they're really freaked out by what's going on. What do your contacts say, and you don't have to name names, but what do they say in private conversations about how they feel about what's going on right now? What do they tell you?
Well, again, going back to the central bank side, they are scared about a sudden drop in liquidity where the whole system freezes up, and at that moment, they don't have the tools that they've been using to aggregate and sort of go forward and to help the financial system. But they're still focusing, again, on those banks. That is the problem. They fear a liquidity squeeze in a bad moment, and that they might not be able to persevere in helping the financial system, the private system at that moment, but they're still not doing anything different. So that's a definite fear. And people are afraid more and more of what's going on. You hear the stocks being touted on all the mainstream media. You should buy. This is a good buying time. Greece is better now. Whatever the reason of the day is. But I think real people are very concerned about that, and they're also concerned about sticking their neck out and doing something new. So it is a time, and I think that's what some managers are seeing as well in terms of funds. It is a time to take a breath as a smaller individual, and not necessarily to bet big right now because of all the uncertainty that's in the market right now. And that's what I'm hearing, that the demand from a small person basis for anything is more muted now than, say, it was a year ago because there are concerns. There's more disbelief about the messaging than I think there's been before.
Nomi Prins, best-selling author, your latest book, which is out in paperback, All the President's Bankers. Here it is. You can see it. You can get it. There'll be a link after this interview on the USAWatchdog.com site. And Nomi Prins, thank you so much for joining us today on USAWatchdog.com.
Thank you.